All right, so a largely in-line credit policy from the Reserve Bank of India, status quo is maintained, and a growth-oriented commentary comes in from the governor. The repo rates are left unchanged at 6.5%, and the RBI's FY24 GDP projection is also at 7% versus the earlier 6.5%. Additionally, AMFI data for the month of November is out, and SIPs top 17,000 crore for the first time. Flows in small cap funds are largest in the equity segment, and the month saw strong inflows from small and mid caps too. So let's discuss all of this today. I have with me Lakshmi Iyer, CEO, Kotak Investment Advisors, Kaustubh Belapurkar, Director, Fund Research, Morningstar Investment Adviser India. Good evening. Welcome to the show. And Lakshmi, I'll come to you first because we need to really decode the policy stance, because my viewers, especially the ones who have the EMI runnings, no relief for them, but the good news, no more rate hikes for them also, at least for now. What will you say?
Absolutely, Kavita. I think that's been the messaging in the last two policies also. Of course, this one was almost sans any surprise, and also, quite vehemently maintaining a balance, yet talking about the growth prospects, given the fact that we are the largest and the fastest growing economy, not largest, I would say the fastest growing economy in the world. And I think to be able to support that, we require the other levers, including the interest rate levers. So I think in that sense, even rates plateauing out is definitely good news, given the fact that the next action from here, as and when that happens, maybe with the 2-quarter lag, is going to be a rate cut.
Lakshmi, also I really want to understand the kind of data that's coming in from the US, and also the Fed official earlier said that we might see a rate cut happening from March, but then there are contradictory reports or experts' voices also that say that Fed is really should be considering going slow as far as the rate is concerned, because for them right now the priority should be not getting the economy in recession. So is it really, should we be looking forward towards this rate cut happening from March, or you think that it's totally data dependent and so far there's no scenario of rate cut happening?
So if you're looking at the Fed fund futures, and that keeps oscillating today, the probability is more than 60%. But for Fed to actually take cue and act, usually looking at Fed fund futures, historically we've seen the probability has to be more than 80% for any rate action. So that's point number one. Point number two is the US data is actually portending very mixed signals. So on one side, where the employment data, we will have the employment data tomorrow, which will give you some more sneak peek into what's happening. The housing data or the student loan data, where the delinquencies are rising, are giving a very different picture. Are we proclaiming, or are we announcing that, or are we sensing that the US is already in a recession? Well, the answer is yes and no. There could be a protracted slowdown. So therefore, the Fed can't completely ignore that when they meet for their policy decision on the Feb 12th and 13th. So I think some of these inputs are going to be very critical. So it's not a given that in March there is going to be a rate cut, because the Fed continues to be an inflation vigilant like every other central banker.
Kaustubh, so clearly no rise in your home loan EMI, but also in the latest data that we also see coming in from RBI, it also says a lot of loan accounts are still attached to MCLR rate, okay, and not the EBLR rate. So now what would you like to say to these people who have like more 6 months left to bear with this higher EMI, just in case of 6 months is the time that we are looking at, and then more clarity on the rate cut scenario we might get. How do you see this MCLR loan borrowers getting impacted now, at least in 6 months time frame?
Yeah, thanks for having me. And I think what's important to think about is just a wait and watch approach. Obviously, I think Lakshmi laid out the levers very nicely, that it's going to be a slow, gradual approach from the RBI in terms of rate action. So I would probably just wait and watch. But I think the good part is that the trend is going to be downwards from here, rather than kind of, there will probably be a pause for a while, and then, the rate cut action can happen, rather than, any signals of, a reversal in terms of going back to a rate hike. So I think that's the positive sign. I'll probably wait and watch as a home loan borrower, and then take cues from there, rather than take any action right now.
Okay, so clearly new loan borrowers or who are about or thinking to take a home loan maybe or any sort of loan, home car, should they be waiting? Is it a wait and watch situation according to you, Kaustubh?
I wouldn't necessarily think so. I would say that the delta, I mean, it's not going to be a very steep cut, so to speak. And, these transmission also takes some time. So if there's a, pending decision that you need to make, I mean, I wouldn't really pin my hopes purely on, rates coming down in a hurry from the loan side of things. So, I mean, I would say that, perhaps if there's no needing or tearing hurry, then perhaps yes. But if there is a need for you to do it, then don't wait for a sort of lower interest rate to transmit to you immediately. It's not in the near future, and it won't transmit right away. Is kind of where we would look at it.
Lakshmi, equity markets are an all-time high. Now, I also want to understand the kind of trajectory we might see the bond yields moving in. Is it going to be range-bound? Early on next year, we have elections. The state elections have clearly given us a picture of it could be a really one-sided Lok Sabha election that we might see. So, considering our domestic triggers, considering the kind of data that's coming out from the US, where do you see the bond yields trajectory moving on?
Is that question for
Lakshmi?
me?
Yeah.
So two things. One is we cannot ignore the fact that the index inclusion will lead to foreign flows much more stronger in CY 2024 than we have seen in the last 2 or 3 months. It's barely 15 days of the month, but almost 4,000 crores of net buying has been done by foreign investors. And bulk of this is coming into that FAR or the fully accessible route securities. That's number one. But in the near term, I think the bond markets are still a little bit shaky about two parts. One is the next two readings on inflation may not be very much on the lower side. So that could be a small party pooper. And second is that liquidity right now is bearable, may get into a slightly tight trajectory. So the risk of an immediate OMO is not there, but still that is clearly impending. And of course, right now we are at that time of the year where banks' credit growth is still not moderated. So that incremental demand for government bonds also not there. So I think if you blend all that into it, very near term, a 720 breaching on the lower side is very difficult. Risk more tilted towards a 735 kind of an outcome. But at those levels, it's okay to build a position and run with it for the next 12 to 18 months.
All right. So in this scenario, looking at the kind of explanation Lakshmi gave, Kaustubh, how should we revamp or rebalance our portfolio?
Yeah, so I think what we should be really looking to do, Kavita, right now, still remain at the shorter end of the curve, maybe start dabbling a little bit. And even if you look at the indications from what bond managers are doing, right, you would see that they've not gone. I mean, they're still sitting on probably in the medium duration bucket, especially the ones that have the leeway to increase. They haven't really aggressively gone, at least a majority of the managers there. So I would say, a large part of the money still remains on the shorter end of the curve, where rates are pretty attractive. And maybe a little bit of dabbling, perhaps on the dynamic bond side. The needle might not move immediately, like Lakshmi said. So I would still stay on the shorter end of the curve for the time being for a large part of my portfolio.
Talking about debt specifically, Lakshmi, time to lock in long term, is it a possibility now? Can we do that? Can we look at long term?
So the yields are lucrative, no doubt. They could see some small downside in terms of price pressure. That's also possible. So if you're not very fixated, understand the curve, the shape of the yield curve was like this. Then suddenly it's become like this. So almost the entire yield curve is flat. So risk reward is still centered around the mid of the curve. But when you are expecting a capital gains participation, so long as you are doing carry participation, it's okay. Once you are playing for a capital gains kind of a participation over the next, say, 6 to 8 quarters, then progressively it makes sense to go long the duration curve at an opportune time. Be mindful of the fact that the moment you enter, you cannot expect yields to fall like 9 pins. That may not happen because there are these other factors that we just discussed. So keep that in mind. But yeah, within the long debt space, I think the gilt space looks the best, as Kaustubh rightly said. between dynamic bond funds or gilt funds, which are running reasonably higher durations relative to the other, should be your port of call.
Uh, 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 in this situation, Kaustubh, we also have to talk about the AMFI data that came up today, earlier in the day. And SIPs have crossed 17,000 crore mark, and we've also seen a large part of money coming in the small cap and mid cap. People have started believing in active large cap also, as per the data. Now, where do you read out any specific trend coming out from this data, or it's expected?
It's kind of expected, but I would just, kind of maybe caution investors, because I know, there's a lot of optimism about, the mid and small cap space, and rightly so. Great long-term wealth creators, and the last few years have been the superlative run in this space, right? I would just take a little bit of a pinch of salt, for investors, that given where we are at and the way the market has moved, temper your expectations, because obviously you will have periods of volatility where these counters can potentially, fall, in a correction much more than, say, the more or the less volatile large cap counters. So you'll have to kind of think about slightly more patient long-term holding when you think about small caps, and don't go overboard. I think that's very important to think about from investors' perspective, because right now the data is suggesting that a lot of money is really being piled purely into small caps, from an overall portfolio construction perspective. And I would just probably, ask investors to do a, overall check that they're not going overboard in their portfolios on small caps, because that can be a little detrimental, especially when they see heightened volatility in that segment over the short term.
A word of caution from your end to our viewers, and also a lot of viewers, specifically the SIP ones. When they see market going one way, they get really scared. So they even get scared of a market giving them good returns. Either they stop the SIPs or maybe just book profit from whatever they've earned. So how would you deal with that kind of a fear mindset? Lakshmi?
So, the only, I would say virtue in this kind of a market is don't let your greed overcome your discipline. I think that's very, very important. If you look at the last 12 months, the pace at which you've seen a small cap index deliver returns, it's been almost 3 times or 4 times the broad-based index, which is the Nifty or the large cap index. So I think earnings in some of these mid-market segments have not really kept pace with the pace at which the price or the P has moved. So I think some of these reality checks will continue to haunt as we go into the new year or in FY 25. So I think keep all that in mind. If you are constructing a portfolio today, don't try to time the market and take those calls. It's okay to be a benchmark hugger, buy the index, buy the market, be a large cap oriented portfolio. And I completely agree with Kaustubh. There is excessive froth which is building up. Knowingly, unknowingly, doesn't matter. But I think the mindset today is that, I can never lose money in a small cap or a mid cap, which is a complete fallacy. In long term, yes, but in near term, you need to be prepared for some kind of, a shakeout sooner or later. We don't know that. So keep that in mind and stagger your investments if you are doing mid-market or small cap kind of investments, and you're okay to do lump sum if you're doing a large cap investment.
Coming in from Lakshmi, and with that, Lakshmi, thank you so much for being on the show and helping our viewers with that today. Kaustubh, request you to hold on, because we'll slip into a quick break, and post that we'll be joined by our viewers, and Kaustubh Belapurkar will do live financial planning of our viewers after this break.